Good morning and welcome to the Eve Sleep PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand over to Tim Parfitt, CFO, and Cheryl Calverley, CEO. Good morning to you both.
Morning.
Good
Thanks,
morning.
Alessandro. Welcome. Thank you for everyone for joining the call this morning. Hopefully by now you've had a chance to review our results from 2021. In the Eve office this morning, you've got myself, Cheryl Calverley, the CEO, and
Tim Parfitt, CFO.
Hoping you can see the slides on our screen. We're going to share a few more slides than we normally do. We promised in our last investor meet presentation that we would share a little more information with investors, so we're trying to do that today. So bear with us. We've got about 15 or 16 slides of content, and then we will open the floor to questions and answer as many as we can. Okay, so without further ado, we'll move on. So what we'll cover some business context. We'll cover where we are and where we're going, look at our future growth, and then we'll get a small insight into our current trading and outlook. So 2021 business performance. The headlines are, it's been an incredible year of progress. I mean, 2020, as everyone knows, was a really unexpected year. And 21, I think, was a year where we were able to cement our position. Financial headlines, I'll hand over to Tim to talk through.
So we've got them here. I mean, you may have seen them already in the RNS we put out this morning, but group revenues were up 6% on 2020. We improved our marketing contribution by 5%. So that's the profit that we've made after accounting for all of our direct manufacturing costs, all of our distribution, all of our marketing. So pretty much everything before our office overheads. So that's as a percentage. The actual marketing contribution was down. We'll talk a bit more about that later. It was really due to the investment that we made in France. We closed the year with £4.5 million of cash and no debt. Operationally, we had the first and second best mattresses in the UK, according to Which.
And I'd like to add to that, we also have the best mattress in France, according to Consumables, which is the French organisation. And we have hot off the press another best mattress in Consumables, which will be announced very shortly.
Our repeat rate was 12%. So that's customers who first ordered from us 2 years ago. 12% of them subsequently went on to place another order within 2 years. We've now got about 50 SKUs, including wellness and gifting ranges, and we'll talk a bit more about those later. And our average delivery time for large items was less than 10 days. There's been a lot of noise. I'm sure most people are aware around delivery challenges in the UK during a COVID period. So I think there's been challenges with courier companies. There's been challenges with having the right stock, generally in the market, in e-commerce, and in furniture. So I think we can be pretty proud of our average from customer placing an order to actually getting their item in their home is within 10 days. Right, so the numbers in a bit more detail. You'll see there, probably it's worth talking about the growth from 2019 to 2021. So it's sort of pre-pandemic to sort of coming out of pandemic. So revenue, we've grown steadily over the 2-year period from 19 to 21. Our total revenue was up 11%. And it's continued to move up. You'll see there. So we increased our revenue from 19 to 20, and then again from 20 to 21. So we haven't sort of suffered a post-COVID hangover. Our gross profit has improved, so up by £2 million over the 2-year period, which is a 16% increase. And our margin has improved. So you'll see there 53.1% in 2019, up to 55.4 in 2021. So 230 basis points increase. Marketing contribution has been a massive shift over the 2 years. So 2019, we had a negative contribution of £2.5 million, and that's moved to a positive contribution of £3.1 million. So a massive swing and improvement of over £5.5 million there. And our underlying EBITDA loss. So back in 2019, our EBITDA loss was £10.9 million. We had the COVID bounce in 2020. So there were lots of things that happened in 2020 that were sort of, unexpectedly benefited us, if you like. Marketing became cheaper, so TV space became cheaper as holiday companies and other businesses selling big ticket items withdrew from TV advertising, and we were able to take advantage of lower rates there. So we benefited and unexpectedly reduced our EBITDA loss to 2 million in 2020. 2021, the loss widened, but as I've mentioned, as we'll talk a bit more about, we invested more in France, particularly, and a French TV campaign to reinvigorate growth in the French market. So over the 2-year period, you see we've reduced our losses by 73%, and then the statutory loss after tax we've got there is the same sort of improvement of 74% over 2 years.
We wanted to give a little more detail, very aware that we don't often talk about the individual bits of the business, but there is quite a lot of sort of movement across the different channels and markets. So Tim, do you want to just...
Yeah, so this gives a bit more insight and flavour from the figures on the previous slide. And as Cheryl said, we've broken down here the revenue split between our different channels, our direct-to-consumer, our B2C, and our B2B, where we have relationships with retailers. We'll also split it there between UK and Ireland and France. And the big call out there is really the UK direct-to-consumer business. So you'll see back in 2019, our revenue in that market was 12.8 million. And we've grown that over the 2-year period by 49% to 19 million in 2021. At the same time, you'll see the marketing contribution, the second to bottom line there in the table. We were negative in 2019, and we were negative in UK and Ireland, and also in France. And you'll see the big swing there to 2021. So we've gone from that negative marketing contribution of 2.5 million to 3.2. The massive swing is in our UK business. So our UK business has improved from a 1.7 million pound loss to a 3.7 million pound positive contribution. And the margins below, the marketing efficiency, below, you'll see that the total marketing efficiency, so that's marketing investment as a percentage of our revenue, it was 51% in 2019, roughly evenly split between UK and France. And we've pretty much halved that over the 2 years. So we benefited in 2020 from a lot of positive headwinds as a result of COVID, but we've also held on to that margin and that efficiency in 2021 in the UK. So UK and Ireland efficiency has doubled, more than doubled in the 2 years. And that's brought the group, at a group level, we've moved from 51% marketing spend as a percentage of revenue to 27%.
And just wanted to really pick up on the UK B2C. So if you think about the way we are developing the business, we're developing our biggest core market ahead of the rest, and the rest kind of follows. So we learn and then we roll out. So UK B2C or direct-to-consumer channel is our biggest channel, and it's the most developed channel. We wanted just to pull out some of the data on UK and Ireland and on D2C specifically.
So as we saw on the previous slide, so over the 2-year period, the total UK and Ireland business has grown from 18.5 million to just above 22.5, and the marketing contribution has improved by 4 million pounds there. 5.4, get the maths right. And particularly the UK D2C, 12.8 million in 2019 up to 19.1. So that's the 40% growth. And pleasingly, what we've seen, what we've been able to achieve is a significant reduction in our marketing investment in the UK market. So our total UK marketing spend in 2019 was 9.7 million, and by last year it was down to 5.4. And at the same time, we grew our revenue by 40+%.
It's a great example of almost the pattern of business. You have to overinvest to generate momentum in a business. So if you look at 2019 in the UK, the investment is a heavy investment, and we made heavy losses. That you then see come through. So now in 2021 and onwards going forwards, we see that we need much less investment to maintain much greater growth. That's exactly the pattern we are following in France. We're earlier in the investment journey in France. So at the moment, France is in that overinvestment stage to create the momentum, which we will see flow through in later years. So it's a fairly classic pattern of business.
And our cash flow over the same period. So we've shown here the cash flow between the two halves of the year. So cash doesn't move in a sort of a linear fashion from one month to the next and one half of the year to the next. So we often have bigger marketing investments in the first half of the year. We pay up front for TV campaigns that are running throughout the year. So that was the case in 2021. So our cash outflow at the beginning of the year, at the first half of the year, was 3.2, and the second half year was just 0.7. Looking back to 2019, I mean, you can see in both halves our outflow was more or less £5 million in each half of the year. Significant improvement in 2020, but at the first half of 2020, we benefited from saving some VAT payments under the government's coronavirus support measures that we decided to take advantage of, deferring VAT from H1 in 2020 to H1 in 2021. We also reduced our inventory in the first half of 2020. And in 2021, we recognized that in order to be able to continue to meet our customers' expectations, we actually needed to hold a bit more inventory, and recognizing the challenges in the supply chain. So, and I think that's probably borne out by one of the earlier slides where we said that our average delivery time was less than 10 days. So in 2021, you can see there's a bigger outflow in the first half of the year. Some of that was upfront marketing investment. Some of that was investment in stock. Some of that was repaying back from the previous year. But by H2 last year, our outflow had reduced significantly, just down to 0.7 million.
So we're next. We laid out a 2-year plan about 18 months ago, and it had these 4 parts to it. So number 1, sustain UK growth, and I think you can see we are maintaining, sustaining, and indeed accelerating that, which is very pleasing. Accelerate France. France is very early, so we are 9 months into our investment in France. Our very first investment in France was last May. It's now March. We're starting to see the acceleration. There's some really good signs, particularly from the last few weeks. Although, obviously when we laid down the plan, we weren't anticipating anything like the headwinds we have globally at the moment, including the conflict in Ukraine. So the market is challenging, but I think all markets are challenging and almost impossible to forecast at the moment. Entering new markets. So this is first and foremost a satellite strategy. So making sure that where we could enter markets from existing markets without incurring incremental logistics or product challenges, we would. So Ireland was our first there, and that's going really nicely and is showing very strong year-on-year growth. I don't have the number in front of me, but very strong year-on-year growths. We have the next satellite market in mind, which is likely to be Belgium. We're just working through the final stage of that, and we will hope to see a similar sort of pattern in Belgium running from France as we do Ireland running from the UK. And the final one is to build operations for efficient scale. Now, this has been obviously challenged by COVID, and there was a period certainly in Q4 last year where the ability to build operations was faced off with the fact that around a third of the logistics network was off with COVID, and we went through a difficult period of handling that, as I think did every retailer. It's really good now. We're back on a much more even scale, and we have an operation which is really efficient. It's running incredibly well. Customer service is superb, and then our overheads are being very, very well managed as a proportion of revenue. So we're feeling really confident there as well. Excuse me, I just moved my cursor off. There you go. So I'm going to be. So, talking about it as an overall pitch, I think it's quite important to look at the journey of Eve, all the way back in the day. And I think the important bars here, the yellow bars, which is our core revenue, and the pattern that's followed throughout the rebuild strategy, which, as I say, we kicked off in 2019. And then the black bars, which is the underlying EBITDA. And 2020 was an anomaly. So the EBITDA was not planned to be as good as it was in 2020, and it can sort of flatter the progress. The progress is consistent from 2018 to 2021, and we would expect that trend to be continued. And what you've got underneath, for people that would like to take the time to read it afterwards, is just some detail as to what happened in each year. I think it's easy for us to get ahead of ourselves and forget the consumers come slowly. So we kind of go, we've done this. Why hasn't it had an instant impact? Well, quite honestly, business takes time, and when you look at it over time, the progress is really, really pleasing. So, reflecting on what's in the business today, which is what we ride on to build the future, and I'll talk a little bit to the future in a moment. So first and foremost, we are a direct-to-consumer business. We will always work multi-channel and omni-channel where that is right for the customer, and customers do shop this category, what what's called omni-channel. So they might try a product in store and buy it online, or vice versa. But fundamentally, we like to have the relationship directly with the customer. So we will always construct our offer to be better for a customer if they buy from Eve directly, whether that's the free trial period we offer, the risk-free trial period we offer, whether it's pricing, whether it's customer service, whether it's additional products or promotions. That allows us to develop a relationship with the customer, which gives us the ability to create long-term value. It gives us the ability to sell against that customer, to engage them over their whole journey of sleep wellness, and to understand what it is they need from us going forward, so that the business generates real organic customer momentum. It's a high-quality brand. We've very carefully crafted the brand, as I'm sure people can see by spending any time with any of our advertising or website or indeed products. That allows us to support premium products. A significant percentage of what we sell is at the premium end. It allows us to attract strong retail partners. So, the DFS relationship, quite frankly, DFS phoned us, and DFS told us they would like to list us. We're in a very pleasing balance of power in the negotiations, given the relative sizes of the two businesses, and that is because of the strength of our brand and our product range. It allows us to support stronger margins. I mean, margins are, I think, going to be under pressure over the next year with a combination of input pricing and customer inflation, and we will endeavour to keep prices as accessible for customers as possible in what will be a trying time. But nevertheless, we can deliver stronger margins due to the strength of the brand and the value perceptions we deliver. And it also means we can support a wider product range. So when we say, we can put the Eve brand onto products as wide as a weighted blanket, a bed frame, a mattress, and even a CBD oil, all those products will sell and are selling effectively under the Eve brand because the brand is strong and it is broad. Our culture here is phenomenal. And this morning we've just been announced as a campaign Best Place to Work, which is a very pleasing thing to see. The team is very engaged. We attract high performing talent. We deliver high quality output. As with everyone else, there has been a post-COVID change. There's a lot of people who've been sitting on changing roles, changed roles. But as we've attracted new talent to replace those people who've decided to move on, the talent we've attracted has been very high caliber for what is a sensible overhead for the business, which is really, really important in a small business. With 55 people, which is all we are, every single person's day-to-day counts unbelievably. The systems and processes are maturing, so you can see the increasingly tight management of the business. So, waste is reducing, costs are reducing, cash burn is well controlled. The business is a very well controlled business. Our ability to pull levers and manage our P&L is excellent. I think you've seen we've hit our forecasts. I think for the past 2 years consistently yeah. Due to the tightness of the business. Again, very important as we go into yet more uncertainty. Be able to manage stock effectively and manage our customer experience effectively, in the face of global challenges is key. And then finally, we've got a scalable operation in-house. So, you can choose to outsource all of your logistics and all of your customer support. You can do customer support from, the Philippines or, globally, and you can outsource your logistics. And whilst that can then give cost improvements, it gives, in the long term, increased costs because you're unable to develop new services. You're unable to be responsive to customer needs. And actually, you find yourself in a position where your brand experience drops and you aren't able to keep ahead of the pack. We do our logistics and customer support operations in-house, so within Eve, from here in Camden and obviously remotely. That gives a really low-cost platform, but most importantly, a responsive platform, so we can innovate that customer experience and we can support a scaling business, and it gives us the flexibility to try new things as any young, innovative business needs to. So we talk a lot about sleep wellness. The most obvious representation, although there's a lot more to it, is which categories you operate in. We've been operating in mattresses since we were born, back in 2016, and that's our biggest category. We moved into furniture about 4 years ago now, maybe 3 years ago now. That now represents around 8% of the value share. Filled, which covers things such as duvets and pillows and toppers and various things in that space, represents around 5% of the business. Textiles is 3%. We have a baby offering. Baby is an interesting category. It's an obvious place to go for a sleep wellness business, but it's actually quite a niche category. So finding the right offering there is key. It's unlikely ever to be huge, but it is a very key representation of the brand as operating across sleep, because you want to sleep like a baby. And then what we call here the accessories business, which is our wider range of sleep wellness gifting. We've only been in that market for just over a year. And we're slowly starting to see different areas of that grow in more effective ways. It very much for us is a test and learn category. It gives us a space to understand where we should work with retailing partners and other brands, where we should do things under our own brand, and where there's opportunities to innovate. So to future growth, this is what we are trying to do as a business. We're trying to build a sustainably growing business with strong margins and with multiple net revenue streams. We have the often asked about profitability, and I've often said, and I'll say it again, you can choose to be profitable, but if you choose to be profitable, you will curtail your growth. And we are trying to create a balanced business that's both growing, thriving, growing at the top line, and delivering sustainable profitability. And that does mean there are areas where we will choose to invest ahead of profitability, France being a great example. We will deliver a business with strong margins, which means the premium brand and the premium product offering is core. And over the time, we will be looking to develop more revenue streams. As you can see, we operate in 6 categories. We'll be looking to grow further revenue streams and ensure we are not dependent on a narrow revenue stream, which is a little more subject to the vagaries of customer demand. We talk about being a sleep wellness business, and we do an awful lot of research, so we're not building that strategy from a whim. And what I've put in here is just some very, very simple research that we do bespoke in sleep. So this is a research survey that's done. In this case, this is the UK data. We've done this in France, and the data is the same. And this is done with 2,000 UK adults. And as you can see, over 50% of the UK have invested in a sleep product in the last 3 months. So that's the left-hand chart. Sleep products, in their broader sense, have a huge penetration. That is reflecting the fact that over 2/3 of the UK are worried about their sleep. And actually, the French data is slightly more than 2/3. So when you ask a customer how much you worry about the amount of sleep you're getting, over 2/3 say a little or a lot. So we understand that there is a sleep challenge in the UK, and I don't think anyone could avoid the constant noise. And sleep is absolutely being recognised as the fundamental underpinning of wellness. And what that brings you to on the right-hand side there is the number of people who are buying products right across sleep categories. So I think there's been a lot of time thinking about mattresses, but actually over 1/5 of the UK have bought a product in any one of 5 sleep categories that we look at. So categories running across your sleep environment, things you eat to help eat or drink to help you sleep, eat, drink, or put on your skin to help you sleep, what we call consumables. Sleep tech, so that's tracking and apps for active sleep improvement, so everything from a Fitbit to an Apple Watch. And then specifically medication. I mean, Eve is not looking at medication, but it's interesting to see that 20% of the country are using medication to help them sleep. So sleep wellness, sleep tech, and where we take sleep as an industry is right at the forefront of our minds. So against that, we have 3 pillars to our sleep wellness strategy. And this should, I think there's a couple of questions that people have asked about what does a sleep wellness business look like? What does it mean? Well, it's this. So it addresses there are 3 things that stop you sleep. Either you're not physically comfortable, your environment isn't comfortable, or you're not comfortable in your mind, you're not mentally comfortable. So we build products that deal with your physical comfort, and that's our core business. So everything from mattresses to duvets and bed frames. We are building products that help with your environmental comfort. That's our wider sleep wellness retail offering. That tends to be a little more with partner brands, although we do some brands ourselves. So that's everything from lighting, storage, scent, noise control, and sleepwear. And then products that deal with your mental comfort. And this is an area we haven't explored particularly, but we are just starting. And this is where additional revenue streams come. But there are products in this space, consumables. So the CBD oil we've launched under license is a great example of a consumable that helps you mental comfort. And various sleep tech and sleep apps. So we're exploring what happens with everything from your headspaces and your mindfulness apps and the role they play in improving sleep. This is an area of almost left to right. Left is where the existing business is. Middle is where we're just putting our toe in the water, and right is where we're currently researching and exploring. The business will move to the right. And as you can see, as you move from left to right, your costs reduce and your margins improve. All of this has to be underpinned by a very strong data capability. And again, this is something we've really just started on. We invested in a strong data director who joined us in January. And he is in the process of, he's from John Lewis by background, and he is in the process of building out a much more effective data capability to underpin the business. And wherever you look, particularly in the direct-to-consumer business, where you have access to an awful lot of data, data really does drive the business, from marketing efficiency, accelerating e-commerce, through to how we manage our stock. And in the longer term, if you think about that right-hand side, how we drive content and services much more algorithmically to customers to take revenue. So that's kind of where we're going, and I'm hoping that will give people a little bit of context, as a little more meat on the bones when we talk about sleep wellness business and the vision we've got really for Eve. But our current trading, Tim, do you want to talk a little bit through this?
Yeah. So so January and February, our group revenues have grown against 2020, so pre-COVID. So we're up against that period. In terms of year-on-year comparison, so Q1 2021 was very strong for us. We were in various states of lockdown. The high street was closed, and we benefited from that. So comparing this year to last is not necessarily a good indication of our performance, but compared to pre-COVID, we were up. The year-on-year comparisons will get easier from the start of May, when if everybody remembers in 2021, I know the 2 years are sort of blurred together for me. May 21 was when everything sort of started to unlock, and consumers were able to go on holiday again, and they were able to spend on leisure activities, and their spending habits sort of returned back to somewhat pre-COVID normality. So our year-on-year comparables will certainly get easier from May. Demand has softened. I think that will come as no surprise to anybody. If you read the press and look at the media on a daily basis, the path for consumer spending is unclear. So there are lots of pressures on consumers, on cost of living increases, the cost of fuel going up, cost of everything in shops is going up. The conflict in Ukraine has certainly damaged consumer confidence. So what happens from here on in is unclear, and we remain to we'll see what will happen there and how that will impact us. But we will remain as nimble and flexible as we can, and we'll react to consumer spending habits as they become clearer.
I think that's a really important point. I don't think, and I realise that probably every business has said this every investor meeting for the past 3 years, I don't think there's ever been a harder time to forecast. So the most important thing for us as a business, and indeed every business, is to remain resilient and remain flexible. And we will work very hard on remaining resilient and remaining flexible, and being able to change our approach as we need. We will focus on, one thing that is absolutely without doubt is consumer confidence is down and consumer spending is under pressure. So we will focus a lot on maintaining sensible pricing. So I wouldn't be expecting to see. I'll be expecting to see us try and maintain underneath inflationary price rises. Aside from that, it's impossible to forecast what the year is going to do, I think.
So some things that we've done and will benefit from over the coming months. So we had new ranges that we launched last year, so we will see the annualized benefit of those. We will of course have new things coming out later this year. We've launched a partnership with DFS, as we've already mentioned. So that went live on DFS website in March, and will be coming to stores in the coming months. We have a Channel 4 sponsorship arrangement, so we will be sponsoring late nights on 4 from April, and that runs for the whole year. And as has been mentioned, we've expanded our data team so that we can start making better use of the data that we already have within the business, and improve our marketing efficiency and customer lifetime value further. So we are targeting top line growth in all markets for the year, and we are focused on UK and Ireland reaching break even for this year.
So without further ado, we can probably go to questions, I think.
Yep.
Cheryl, Tim, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We received a number of pre-submitted questions today, mainly around the DFS deal, and I want to start the Q&A session off with these. The first one reads as follows. Congratulations on the DFS deal. It could very well be the turning point for Eve long term, especially given macro headwinds over the last few months. What impact do you expect to see on your 2022 annual performance, especially in terms of increased sales, increased EBITDA, and increased bottom line?
And there are two other questions. I'm just looking at the Q&A also regarding DFS, which is one about how are DFS sales going and who delivers DFS purchases to customers, and then a very similar question on DFS sales, and so we might just do a whole answer on DFS, if that's all right. So the practicalities. So who delivers DFS purchases to customers? DFS does. So we deliver in bulk into DFS's warehouses, and then they manage the customer from there. How are sales going? Well, it's 3 weeks in, so from DFS say they're very happy. We haven't got much of a sense of what DFS sort of normally see, but it looks good to us. It's very hard to say 3 weeks in. In terms of the impact on the full year, Tim?
So DFS is one of several partnerships that we have with retailers. So we work with Next, we work with Dunelm, Argos. We have worked with others in the past. So we haven't put any specific targets on what DFS is going to do for us. It's very early days. It's a new relationship for us. We will see how that works out over the coming months. But we expect it to sit somewhere in line with the other partnerships that we already have. But we'll be delighted if it outperforms the others.
I think the most pleasing thing about the DFS relationship for us is it's a partnership. What we try and do is build partnerships where we can create a product set that really suits the customer for that partner, and often it's a customer that is a different customer to the classic Eve customer. So Argos is a great example. That's a partnership where they range a set of products that you can't buy on the Eve website. Some you can, but some you can't, which we design with Argos for their customer, understanding their customer needs. DFS is a very similarly engaged and collaborative relationship. They're looking to craft the right range for their customer, put that range in store. So we are talking about which are the right bed frames for those customers, whether there is a bedding offer, and whether there is a much more joined up Eve offer. That makes it a much more positive and engaged partnership than I think some of the other partnerships. And historically, we've had partnerships with people like Amazon and Dreams, and clearly those are not the sorts of places where you can build a really strong customer relationship. They are kind of volume plays to the point where both of them were sort of margin deleterious. So we exited both those partnerships.
Perfect. Thank you very much for that. The next question asks if you think DFS will try to buy Eve Sleep.
we did.
No
we saw this. Yeah, no, we were looking at something, and someone had said this popped up. We have no insight as to what DFS's corporate strategy is. I mean, obviously that's not the conversation we're having. We're talking to the sales and commercial and marketing teams. They've had no. That's not the conversation we've had. This is a retail relationship.
Perfect. And the next question sort of relates to the last and asks if a bid does come in from DFS or another company, what would the board consider a fair price to sell Eve at?
I don't think we can speak for the board, so I don't think we could. I don't think we can answer that question.
No, I think the board would be obliged to take any such approach on its merits and in order to seek the best outcome for investors. So that would depend on what might come in. But
thank you very much. That actually concludes the pre-submitted questions. And as you can see, we've received a number of questions throughout today's presentation. And thank you to all the investors for submitting those. Could I ask you to read out those questions and give responses where it's appropriate to do so, and then I'll pick up from you at the end.
So first question is, you mentioned in the previous update that you're on a journey to participate in more investor roadshows to seek new investors. How's that going? I don't think we said it was to seek new investors. I think we just said it was to participate and give more communication. So for real clarity, we are not actively out, sort of trying to seek new investment. That's not our strategy. So we're not out at sort of investor roadshows. What we are committing to do is to give our existing and potential investors that may be wanting to hear more of the business more insight, and that's part of the reason we've given a longer presentation today with a little more strategic detail. And I'm hoping those on this call have found that useful.
But I'll add to that one. What we also do, as well as this format, is we have conversations, and we will be this morning talking to our brokers at FinCap who have relationships with corporate investors or high net worth individuals. So we're talking to retail investors through this format, and we talk to FinCap separately.
So why is France being pushed when it seems to be declining, yet the UK is increasing? I touched on this in the presentation, and I've touched on this a few times. Any market, if you stop investing in it, has a period of momentum. It's like a bicycle. If you stop pedaling it, you have a period of momentum, and then it slows, and eventually it stops. And so you have to take the decision of whether you want to pedal again or not pedal again. We have done an awful lot of looking at our numbers. There's been a lot of times, I'm sure you understand, forecasting the business, and we took the decision that the momentum we had in France meant it was worth investing in to continue, because otherwise the business would have slowly eroded to nothing, and we couldn't see, and we still can't see, a better investment to deliver that top line growth. In France's 4.5 million revenue to the business, we don't have another 4.5 million revenue opportunity that we could alternatively create for the investment that's in France. But the investment that's in France is what is needed to regain momentum in that top line. It is classic business. You have to invest to accelerate a business, and investment, unfortunately, always comes before acceleration. It is just the nature of business.
I think the next question was a very similar topic, so we will move on to world's first digital sleep wellness retailer. What does that actually mean?
And what products are planned. So I'm hoping in the presentation I've given you've got a little more insight as to what's in a sleep wellness retailer. So it's a combination of products to solve your physical comfort, most of which we currently stock, products to improve your environmental comfort, a number of which we are starting to stock and work with retail, branded partners to retail. And then it's products to improve your mental comfort, which at the moment we don't do an awful lot of. We have a small play in CBD, and we're exploring where we take technology. I'm not going to tell you exactly what products are planned for this year because I'd be showing my hand to competitors. But I'm hoping you can understand from that strategy where we're exploring. And if you do reflect on the deck, you'll see the categories that we are investigating. And then has the Eve MPD team thought about introducing silk bedding or duvet sets? We look at all parts of the category and all subparts of the category, and we always assess whether we think there is growth, whether there is enough scale to merit the stock, and whether there is margin. So silk, along with all other materials, is a material we look at a lot. What you have to be very careful of in a business like ours, and you've seen what the stock holding is taking on SKUs or lines which are, whilst very exciting, are very small sellers. They seem exciting and they get lots of coverage in the press, but in reality the category is very, very small. Baby mattresses are a great example. I mean, it seems an obvious thing to do. It's actually quite a small category. So at the moment, we've had a bit of a look at silk, and it's quite small. It's probably a little bit too small for us to enter, but it wouldn't take it off the table.
Would we consider a merger or acquisition with a company or private equity to give Eve more firepower? We sort of touched on this a few minutes ago. I mean, the board would have to consider any such approach on its merits, but that will be the board's remit to do that and to see the best outcome for investors.
Do you see Eve as a self-sufficient company, cash generation wise now? I.e., is there any chance of equity raises in the next couple of years due to cash burn? Do you want to put on that?
Yeah, so we closed the year with £4.5 million in the bank. We believe that gives us sufficient buffer and sufficient resources to meet our plans for this year. And we as we said, we're aiming for UK and Ireland break even this year. So as we see it at the moment, we believe we have enough cash to meet our immediate plans.
It's a very similar question, I think, in the next one. So in the 2020 final results Investor Meet company presentation, you stated that A, you would reach sustainable profitability in 2022. I think we said the UK and Ireland would reach profitability in 2022, actually, for clarity, and that you have enough cash in hand to reach profitability and a placing was unlikely. Obviously, this is no longer the case. What changed? I don't believe this is no longer the case. I think we still believe we have enough cash in the bank to reach our plan. So I don't think that has necessarily changed, but obviously the world has changed. So we shall see. I asked this question in the last Investor Meet presentation and was brushed aside. My apologies, that wasn't intentional. Would you answer it, please? I'm hoping we've answered it now. So nothing has fundamentally changed. We said we would reach UK and Ireland profitability in 2022, sustainable profitability after that. We have enough cash in the bank as it stands to achieve our aims. Clearly, as I say, the world has changed. When we built our plans 2 years ago, there wasn't 10% inflation in them, and there wasn't a conflict in Ukraine. But nevertheless, even given all that, we still very much have the same outturn in our mind for this year.
Next question about the Channel 4 sponsorship.
I can speak to this one. So, is the Channel 4 sponsorship part of the price from 2020 and 50% off the cost of the sponsorships? It is not. So in 2020, so Channel 4 every year run a competition where you enter a creative idea against a particular topic of diversity and inclusion. We came second last year, which is fantastic. Now, if you come first, you receive free airtime. I can't quite remember the value. I think it's something like £500,000 worth, maybe even more than that. If you come second, you receive match funding. So you put up your amount of spend and they will then match it. So you get the airtime for 50%. You have to make that TV advert to do that. And making a TV advert to run on something like a Channel 4, so the sort of caliber and quality you'd need, you are looking at a very significant, multiple six-figure number. We decided it wasn't worth the investment of making the creative to receive only matched funding. It just didn't cost in. So as a result, we turned down their very lovely offer and said, unfortunately, without the absolute free airtime, we couldn't justify expending on a new creative asset.
There's another question about cash, which I think we've answered. So we'll move on to director buys. In a nutshell, would the directors buy more shares in the open market to further align their interests with the shareholders? I probably couldn't tell you if I was going to, because that would probably breach all sorts of regulations. I mean, we're normal regular people. We don't have huge sums of money to invest in the stock market. We have bought shares. I mean, Cheryl and I have both bought shares in the past as our chairman. That may happen again in the future, but I couldn't speak for everybody and everybody's investment strategies. I personally hold my shares within my ISA, which is fully funded and fully invested for this current financial year.
You may be slightly oversharing.
I may well be, yeah. So I wouldn't say yes, I wouldn't say no. It could happen, but
just to reiterate, I think it is worth investors noting that directors cannot buy shares in a closed period. And a lot of the year, because of the frequency with which we release results, because we're trying to do the best we can to keep you guys informed, we are in closed periods. So, we are only able to buy shares very shortly after results are released, and certainly not whilst there's, the key piece of innovation or activities happening. And then I'd just reiterate what Tim said. I've got a husband and 2 kids and a house and a mortgage, and I'm just a normal person. So I buy shares if and when I can, but I'm not sitting in noodles of cash.
Thank you very much for that. I think you actually managed to address all those questions.
We have one more that's just
yeah, if you just want to address that, and then I'll pick up after that.
I think it's about cash again, actually. ThinkCap forecast group loss for the year, which will erode cash in the bank. Would we plan to raise equity this year? We've talked about that. So we believe we have sufficient cash in the business to get us through our current plans. So there's no immediate plan to raise further equity.
Thank you very much, and thank you for addressing that last question. And of course, the company will review all questions submitted today, and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Cheryl, could I please ask you for a few closing comments?
Yeah, I think, and I'll reiterate what I said a few times. And actually, this morning I was just reading Lord Wolfson's statement for Next, and he was talking about there's never been a harder time to forecast a business. And that's a business, I mean, goodness knows how old Next is, but it's a damn sight older than Eve. We are in a very young business anyway. Even in normal times, it's a business which is very volatile by the nature of being a small and young business and doing lots of things. The world has turned on its head. It's turned on its head twice in the past 3 years, once the global pandemic, and now with inflation, which is cost-driven, and a conflict in Europe for the first time in my lifetime. We are focusing 100% on keeping this business flexible and ready to move with circumstances. So I'm very aware of trying to not overcommit in some sort of sense of false certainty. We absolutely will hit the numbers we've put out, but quite how we get there, I couldn't hand on heart say I know today what 3 months and 6 months are going to look like.
Cheryl, Tim, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Eve Sleep PLC, we'd like to thank you for attending today's presentation, and good morning to you all.